Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Well, I think we're happy to be surrounded this morning with the India cricket team and the New Zealand side as well. I mean, that's a beautiful looking set, and I hope we start the day with the actual players someday. But, well, this is Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Sunday is the day, guys.
All pumped up, all ready, all getting excited. So, Nigel, what's it going to be? The cup is ours?
The cup's ours. The cup's coming back home for sure. And I'll tell you what, on Tuesday, the markets seem to have found a near-term bottom. India did well. We moved into the finals. Yeah. So Tuesday was the day. Indian cricket team finding its momentum. The Nifty finding its feet. So hopefully when we come back on Monday, things look even better from here on. But the boys are bringing back the cup. I'm not sure. I'm not sure whether one of the boys will say that
it's time for a goodbye.
It's time for a goodbye. So let's see. Let's see whether.
You know, we since we were able to do this now, we could have probably put the trophy in their hands.
It's there. It's there. Trophy, yeah. The trophy's there. And it's on the India side.
Yes,
see,
yes.
there.
Oh, yeah, of course. It's right here.
It's right in front of you. And it's on our side. So that's an indication.
Well, but we don't want to speak.
It's been a good week, actually.
It's been a good
Cricket,
week.
Markets. Fingers crossed.
Fingers crossed, absolutely. And, so that is, of course, on Sunday. Well, let's just sort of rewind back to the markets once again and, of course, take it from where we left off yesterday. And, of course, US is a bit of a problem. And, I've been asking this question for the last at least 10 days. Is a top in for US markets? Is a top especially in for US tech? And the answer more and more and more seems to be perhaps, at least in the near term, temporary, yes. And look at what happened last night. S&P down 1.7, NASDAQ down 2.6. The Russell is down about 1.6% as well. So these are large, meaningful cuts. The S&P 500, well, it respected the 200-day moving average. Actually, I should say it re-respected the 200-day moving average. Intraday, it had slipped below it, but the graphics will move along. It finally ended above the 200-day. In that sense. The VIX was up 13.5% to about 25, nearly $25 index. That hit the it hit the low of 103.76. So 107.5 a few sessions back, and now 103.76. And of course, it bounced back above the 104 level. And that largely was because, the euro was back above the 108 mark, so it provided a little bit of stability to the broader index, the largest constituent of the dollar, the broader dollar index. Now, the news flow, and this is, of course, Trump postponing the Canada-Mexico tariffs to the 2nd of April. I mean, that's essentially when his team will get back to him with the study on tariffs around the world, and then, of course, he decides on what to do in terms of reciprocal tariffs, etc. So this is not going to be bunched up there along with the rest of all the other countries. But markets were unresponsive, and maybe because, there are still large risks looming. I think there are some steel tariffs, etc., which are due next week, and some metal tariffs, and there's been no word that those have been pushed out as well. So the general mood seems to be sell now, figure things out later. Regarding tariffs, trade, and more. The other part, of course, has been the AI bit, tech in the US. And yesterday, the big news, and which kind of sort of went under the radar in that sense, is that Alibaba launched a new DeepSeek competitor. And apparently, what they're essentially saying, Alibaba is saying, is that this new AI agent competitor to DeepSeek uses a fraction of the data that DeepSeek uses, which itself uses a fraction of the data which and compute power, etc., which OpenAI, ChatGPT, etc., use. And of course, they're saying it's equally good, if not better. Alibaba yesterday was up 8% in Hong Kong. Hong Kong itself was up 3%. It's broken out. And Alibaba now is up 60% on a year-to-date basis. And of course, stocks in the US sold off pretty sharply, especially the tech names. NASDAQ down almost 2.6, 2.7%. Tonight, you get the US jobs data. The whisper is that it's going to be a weaker number. We're in a phase of the market where you want the number to be strong, not weak. Strong will be good. But, I mean, we'll see. The median estimate is 160,000 jobs, unemployment rate at about, I think, 4%. Now, market recovery here in India continues, and volumes have picked up. And I sort of saw volumes yesterday, day before yesterday, compared to the last 30 and 60-day averages. Volumes are picking up on the cash side, which is good news on the way up. Now, the big winners have been in this spate of recovery. The metals index is up 10% in the last 3 days, and the oil and gas index is up 7.5% in the last 2 sessions. Remember, the 2 underperformers in this leg have been the Nifty Bank, large FII holdings, and of course the IT index, which is underperformed on a day like yesterday as well. Where do we go from here? Resistance levels first up. Nifty resistance at the 20-day moving average, which is at about 22,801. Actually, there's an intermediate resistance around 22,700, which was the earlier low. But we'll see. We left off at 22,550. Immediate support comes in at 22,353, and which is the 40-hourly exponential moving average. If that breaks, we'll see Nifty Bank support at 48,400, and the resistance comes in at the 20-day moving average, which is 49,096. The Gift Nifty will come up on your screen, and we'll see how we trade, how well we trade going into the weekend. It's always, especially with Trump, any day, of course, is good for surprising and shocking the market. But the weekend, there are 2 days. So that's essentially maybe a little bit of a hiccup at the margin, but 70 points lower, reacting to that Wall Street pressure that we saw. Sribi.
Prashant, if anything, what the last 2 days have told us, the US president and his aides are also watching the markets very carefully. These partial rollbacks that were announced. First, they said that, auto parts, which are under this US-Mexico-Canada agreement, they will be exempt from tariffs. Now they're saying that everything in that agreement will be exempt from tariffs. So at least they're, of course, in tune with what the concerns are. The market obviously is not too enthused about it. That's the thing. But anyway, for my piece this morning, the title that I wanted to go with is India Shines in Global Chaos. And it felt so good to say that because we're saying that after a long, long time, after months of underperformance by the Indian market, we have been the rank outperformers this week. I'll come to that in just a bit. But first, a little more on this whole job situation in the US, which obviously is rattling markets. We'll, of course, get the jobs report tonight. Expectation would be anything between 160,000 to 170,000 job additions. 4% is the unemployment rate expectation. But the other bit, this whole Doge business, that's beginning to bite as well. There is a private report, people who forecast job openings, job markets, and they look at the overall, layoff situation. That report has indicated that the job cuts in the U.S. are at the highest, or the layoffs in the U.S. are at the highest since COVID. 2020, and that's squarely blamed on Doge and the fact that so many federal employees have had to leave their jobs. So that's obviously a big concern. Anyway, all those concerns from Wall Street, they've nicely moved over to Asia. So most Asian screens are negative. Japan's falling the most actually. Japan's down about 1.5%. The Hang Seng is relatively better off. Why is Japan falling so much? They've got twin challenges and worries. One, their yields are surging because the Bank of Japan is hiking rates. 16-year highs on BOJ yields, on government of Japan yields, and that continues this morning as well. And then the yen is surging. It's a safe haven asset. The dollar index, imagine, when we started this month, the dollar index was above 107. Already in March, it stumbled to 104. So it's been a very sharp drawdown on the dollar. And which currencies have benefited? The Swiss franc and the yen. And the yen equation is looking very, very startling now. Imagine, just a couple of days back, we were talking 151, 152. Now it's 147. That's the surge in the yen that we've seen. Yesterday, the ECB cut rates along expected lines. 25 basis points of a rate cut was delivered. They've raised the inflation forecast just slightly. It's 2.3% now versus 2.1% earlier for the year. So that's ECB, as Europe continues to look at a big spending bazooka bonanza as well on several things like infrastructure and defense. By the way, cryptos were interesting. Cryptos sold off, big time overnight. This is despite the fact that executive order for building the U.S. crypto reserve, strategic crypto reserve, that's in. Donald Trump, Mr. Trump, President Trump signed that this morning. But the crypto market is very nervous about this whole tariff business. On Friday, that's today, there is a crypto summit that the White House is hosting, and the who's who of the crypto world will be attending. So let's see what headlines come in. But the sell-off was almost 3% to 6%. Bitcoin, I think, around 83,000 right now. Now coming to the India outperformance, and it feels good to say that because for the week as a whole, the Nifty's up about 2%, mid-cap 3%, small-cap index almost 5%. What a good performance. Lots of green on the screen. And we have to, really pray that the reduction in FPI selling that we've seen this week, that continues. Let's pull up yesterday's number first. Yesterday, the sell number was 2,377 crores. DII buying was not too heavy yesterday, but focus on that FPI number, the sell number. Now let's look at the weekly trend. 4,800 crores on Monday, 3,400 crores Tuesday. Wednesday was less than 3,000 crores, and yesterday's number is looking very good. It's trending closer to the 2,000 mark. If this trend continues, if people realize that now there's a lot of volatility in global markets, US market is faltering, India's already gone through a correction. If that tide starts turning, we are going to feel very, very good. I'll quickly end with some of the stocks that will be on the radar. We'll tell you more about them as we go forward. Loris is investing a big amount of money, about 900 crores in a joint venture. Kalpatru's bagged lots of orders. And Indigo is getting into long-haul flights. They are going to Manchester and Amsterdam non-stop. I don't know if you're going there or not, Nigel. Any plans?
No ways. If I was going to travel anyway, it would be to Dubai for the Champions Trophy, which is not the case. But I'm going to the mountains next week, so I'm happy to visit Raniket, going
Lovely,
to Uttarakhand.
lovely.
That's it.
Yeah.
Let's take stock of the market. Well, you have these macro tailwinds that are playing out, both for the emerging markets with the dollar index coming down to around 104. And the tailwind for the Indian markets has been crude oil prices. It continues to remain lower, and that's very, very encouraging. Moving to for the week, for the year itself, India has underperformed. But after a while, India is the outperformer for the week. You compare us with the Brazilian index, with the Shanghai index as well. Remember, those indices actually have outperformed us. And even the mother market, which is the US market, the Dow, the Nasdaq and the S&P, all of them have had their worst week in multiple months. And on that backdrop, India has been outperforming. And in yesterday's trading session, there was a bit of a short covering bounce that took place, particularly on the Nifty Bank. It didn't outperform, but you saw the open interest, that was a little bit low, while on the Nifty, it was more or less flattish. The FIs, in the cash market, the selling has come down by nearly around half. It's headed towards a net sell number of around 2,000 crores, which is much lower than what we have seen in the past. And just take a look at that. In yesterday's trading session, we had a swing factor of close to 11,000 contracts. That is, 8,000 short contracts got closed out and close to 3,000 long contracts were added. And in the last few trading sessions, well, these net short positions actually have come down, even in percentage terms, from around 85%, it's come down to around 81.5% or thereabouts. What about in stock futures? Well, this is another interesting one, right? The FIs, they were net long on stock futures. We have been making that point as well. Close to 15 lakh contracts on the long side is what we have seen. They have been net long on stock futures. But in the last few trading sessions, if you look at it, the short positioning on stock futures, it's gradually been coming down. And if you just do a summation of this, it's close to around 90,000 to a lakh contracts is what they've covered out on the short side on stock futures, telling you on individual stocks, some part of the short covering bounce has already taken place to a larger manner. Options data comes up for you on the screen, and both these two were fairly active in yesterday's trading session, which brings us to the levels. Going by the options data, going by the technical levels, well, on the upside, the 20 DMA, that's going to be very, very important for the Nifty as well as the Nifty Bank. So you'll get a fresh leg up once this gets taken out. However, going by the options data, that's the important mark on the downside. By the end of today, you want to save this, don't want this to get broken, which is 250 points away from current levels to 22,250. While on the Nifty Bank, last two trading sessions, we have gone closer to around the 48,200 mark and bounced off that. So you don't want these levels to break, and you want the Nifty and the Nifty Bank gradually to move towards the 20 DMA. Talking about the 20 DMA, yesterday a large constituent of the market finally was finding its form. Valuations are in favor, and now I'm looking at a crucial technical mark on it. The Reliance Industries, if we can get past the 20 DMA, that'll be very, very good news for the Nifty, because by itself, it has a large part of the Nifty. So this one as well holds the key, Reliance finding its form, and you want Nifty as well as the Nifty Bank to gradually trend up towards the 20 DMA.
Okay, all right, got that. So let's just hope that the good tidings, good going so far this week continues on Friday as well. So let's get to the equity call of the morning. Chris Wood of Jefferies says that for Asia Pacific ex-Japan relative return portfolios, greed and fear will increase the weightage in China by 2 percentage points to adjust for the recent outperformance. He says this will be paid for by reducing the weightage in India and in Korea by 1 percentage point each. He adds that greed and fear is to make some further changes in the various portfolios. He says the weightings in Alibaba, BYD, Tencent and cattle in the Asia ex-Japan long-only portfolio will be increased by 1 percentage point each, with the investment paid for by removing the investments in Indian Industrial Siemens. So they're cutting back a little bit on India and increasing the weightage on China.
All right. Well, that's the thing, right? I mean, I think this China AI thing is very much alive, and it's sucking a lot of money from around the world into that market. And you just have to see what's happening there with Hang Seng and the tech names there. Robert Subraman is head of global macro research at Nomura. Rob, good morning. We're speaking after a while. Thank you very much. I remember our conversations in your earlier avatar. I think it was in Lehman, but that was almost another lifetime.
That was a long time ago.
A long time ago. But good to see you here on the program.
Good to be back.
So, Rob, what's the there's so much going on, right? Staggering amount of news flow makes your head spin. But if you had to pick this, say, one or two dominating drivers for markets from here, what would it be from here on?
Oh, one or two. I'd say number one actually is the US economy, and is growth going to hold up or not? And number two, I would say, is Trump's America First policies around tariffs. And, there's been a lot of threats, and the market is, seeing through those threats right now. But April 2 is kind of the D-date he's made on whether he really follows through or
not. So two questions. In your opinion, I mean, is there a way to build a base case here, or is it just too wild that they will go through with these tariff increases, or this is all still up in the air and it can be negotiated down to levels where it doesn't really impact things? So tariffs are about 2.5% in the US, average tariffs, and they go up a little bit, but not to crazy, very high levels, but starts to impact global growth. That is one. And second, some have made the point that the Trump especially is not really bothered about stock market levels in his current term. Actually, in the State of the Union address, there was a bit where he said, well, Americans need to be prepared for some short-term pain. This assumption that if markets are damaged, he will not tolerate that in reverse. How true is that? Go on.
Yeah, so two good questions. So let me answer the first one. In terms of the tariffs, so the view we have at Nomura is that he's very serious about tariffs. He's appointed loyalists that are very focused on bringing manufacturing and jobs back to the US, reducing the US trade deficit, raising revenues through tariffs, and dealing with unfair trade. And so we actually take him at his word here, and that we think, yes, there is a bit of toing and froing right now, but ultimately we think tariffs are going to be significant. And the thing that's interesting is that you look at what's happened so far, and the tariff action is already more significant than in Trump's first term. It's been very quiet, but tariffs on China have gone up 20% this year. And yes, tariffs on Canada, Mexico look like they're going to be rolled back a bit. But if you looked at the effective US tariff rate, as you said, it was 2.4% before Trump came into power. It's right now at around 10%. It's gone up a lot already. And so that is going to be, we think, inflationary for the US. We think growth in the US could actually slow, but at this stage we have a moderate slowdown, not a recession, and also growth slowing in many parts of the rest of the world. I would say India looks relatively insulated from this. Now, your second question around, is Trump focusing more on Wall Street or Main Street? I think a lot in Wall Street are hoping for a so-called Trump put, and if the equity market corrects to a certain extent, he will call it all off and he will focus on supporting the US economy. We're not so sure about that. And in fact, we just did some research looking at Trump's first term. And contrary to what many people think, if you look at when Trump accelerated tariffs in his first term, the equity market was actually coming down. He continued to increase tariffs on China. So we're not so convinced that he's focusing so much on Wall Street. And we think this time, more even than the first term, he's focusing on blue-collar workers. He's focusing on trying to rebuild manufacturing, and he said himself there may be some short-term disturbances that the US people and businesses are going to have to tolerate to get through this.
That's a very, very interesting observation and view, Rob, that it's not going to be all about the marching bulls on Wall Street. So this a slightly more convenient narrative that people tend to think, even we tend to think at times, that he will do whatever it takes to make Wall Street happy. Maybe it doesn't play out that way. Got your point. But let me focus on, the silver lining that you just mentioned, which is India. It could be India. Now, tell us if this could come true or whether it's too simplistic. We're getting very excited here. The markets outperformed this week. The intensity of FPI selling has come down all through the last 4 trading sessions. So we're sitting here getting excited, thinking that if it's murky out there in the US, and if the tariff tit for tat continues, then eventually investors start realizing that India is already corrected. Maybe valuations are looking better. Maybe growth will not be that bad. So they will come back. Do you think that can play out, or is that too simplistic, wishful thinking?
I think you should also be excited about the cricket. The cricket's looking very exciting.
Oh, we are. Absolutely. Absolutely, we are. Looking forward to the weekend.
Look, I think for India, as I said, it's relatively insulated. I do feel, looking at India from the outside, I'm based here in Singapore, India is looking in a relatively good spot to me. The first point I would make is just around India's economy. We're forecasting around 6% growth, 6.2% growth this financial year, 25, and around 6 next year. Nomura, we may be on the lower side of consensus, but the point I want to make is, China just announced that their growth target for this year is around 5%. And analysts are saying, if they get to 5, that would be really, really good for China. Many analysts think it's going to be lower than that. India, 6% is seen as low. That's kind of the floor kind of level. So I think India's growth potential is looking very good to me. I think inflation's come down. It's looking like it's going to stabilize around 4%. That's going to allow the RBI to cut rates. We think there'll be another 75 basis points of cuts this year. And that should help stimulate investment and growth. So I think the growth side is kind of, the floor is kind of now consolidating. And if anything, going forward, I think, it's going to stabilize or start to pick up. Second point I would make is around Trump's America First policies. India as well has been singled out for reciprocal tariffs. Many countries have. But I think the fact is that India is not so integrated in this global supply chain, industrial production network. And so I think it's relatively less exposed. India also is a very, very big economy. Its exports do not make up a very big share. So again, relatively less exposed. And the final point is geopolitics. I think ultimately America First policies are about defending the hegemony of America, regaining and make sure it's a superpower. And who's that mostly against? I think it's China. And I think India is a very strong counterbalance to US and China. And that, I think, will play to India's advantage as well. So I'm positive on India. I think if there is, we talked about if Trump focuses more on Main Street rather than Wall Street, if there is a bigger equity market correction in the US, I'm not saying it's going to happen, but it's certainly a risk. There's a lot of uncertainties. I think we will see a significant amount of that money. It's going to flow out of the US somewhere. I think India is an interesting potential spot.
Rob, that's music to our ears. We're loving every bit of what you're saying. So 2 clear headlines that Trump this time is not going to be focused so much on Wall Street, but perhaps on Main Street. And the second is that India could be a beneficiary as a lot of this, global chaos keeps swirling around. The third important piece You mentioned geopolitics. It's after, I don't know how many decades we're seeing Europe talking about rearming itself. Germany is looking at boosting spending. They're making legislative changes, increasing their, debt ceiling, so to speak. And on the other hand, there's Japan. Those yields are surging. I mean, Japan's the one major central bank that's hiking rates while the world is cutting or neutral. So in this whole mix of the way global macros are playing out and what's happening with yields and this huge divergence, where could money go? And maybe just a quick word on the yen carry. The yen surging, those yields are surging. Just because of those differentials, can we expect any kind of shocks in terms of fund flows?
I think it's very interesting, right? We're probably, in a once in a generation kind of period where the global order is shifting. Yes, I think, Europe is really interesting. There is going to be massive fiscal expansion now. We think around 250 billion euros per year. That's around 1.5% of GDP. That means, probably stronger growth, maybe a bit higher, stickier inflation, and maybe higher rates than we thought before for Europe. In Japan, as you say, very different to the rest of the world. They want inflation. The rest of the world is trying to reduce inflation, and it's working. Homegrown inflation is picking up. Japan's genuinely running out of labor, and so we are starting to see more and more wage growth. And yes, we do expect the BOJ to go against the global trend and raise rates again in July and probably in January as well. And we do think that is potentially going to lead to strong capital inflows and repatriation back into Japan. Japan is a huge net creditor nation, a lot of investments overseas, and some of that will come back. So, for the dollar yen, for instance, we're forecasting 140 by the end of the year. And I think the risk is it could actually the yen could be even stronger than that.
All right, Rob, thank you very much for joining us. Interesting conversation as always, and hope to have you back again as we continue to track what's essentially a global upheaval, as you put it. Thank you very much. We'll take a quick commercial break here. We've got also corporate interactions lined up today. We have the management of IRCTC at 8:35 to talk to us about the quarter gone by, the outlook as well. Abneesh Roy of Nomura talks to us about the key trends in the FMCG space. That's coming up at 9. Prashant Khemka is a market master at 9:20. At 9:30, Hexaware Technologies, recent listing, will be speaking with us about their earnings. Rahul Mittal of REITs will be chatting with us at 9:40. Order book in the quarter gone by. 9:50, Rahul Jain of Goldman Sachs talks to us about key trends in banking, with the relaxation for NBFCs, of course, the MFI space as well. And Indianomics, Lata celebrates International Women's Day by discussing finance and economy with 4 top women bankers from Stancy. So that's a very interesting chat you don't want to miss a little later up. Time for a quick break. Our list of top stocks to watch with our research team coming up.
Welcome back. Well, it's time to focus on a lot of the stocks that could be active today. As usual, we have a team standing by with the CNBC-TV18 list of top stocks to watch. And kicking off the proceedings this Friday morning is Rima. Rima's watching out for Hexaware today, right, Rima?
Indeed. So this is the first time the company has reported their numbers post getting listed. It's been a good listing because the issue price was 709 and the stock is currently above 800 rupees. So we're talking about Q4 calendar year 2024 numbers. Quarter-on-quarter revenue growth is flattish, but remember Q4 is a seasonally weak quarter. Year-on-year, the growth stands at close to about 19%. EBITDA margins, as the company reports, has gone up by 30 basis points to 16.3% sequentially. Profits are up 5.4%. Wrapping up the year, for calendar year 2024, the company's delivered a 13.5% growth, which is an improvement compared to the prior year's growth of 7.8%. Now coming to the outlook. Now, historically, the company would always, before it got delisted and now relisted, it used to give you a numerical guidance. This time, they have not given it, but what they've said is that the coming year will be resilient to modest macro changes. 2 out of the top 3 customers are going through consolidation. They won those deals. That will start ramping up in Q2. But there are 2 more significant consolidation deals which are in progress, which can ramp up in the second half of the year. But we'll have to wait to see if the company wins those. But as of now, the outlook shared by the company is resilient to modest macro changes. Back to you.
Well, thanks a lot for that, Reema. In fact, we have the management joining us at 8:30 a.m. later today. So we'll, further check out 9:30 a.m. to check out exactly what's the way ahead. But let's hop across to Vinny. She's here to tell us about Interglobe Aviation. Hi, Vinny. Morning.
Good morning. So in today's trading session, we're expecting that Interglobe Aviation will open up on the green side and maybe fly high as well. They've actually expanded their international operation. First ever launch of its long-haul destination, and this is going to be to Manchester and Amsterdam. That was restarting in July 2025. And for this, they'll be using the leased Boeing 787-9 aircrafts. And this was the recent damp lease that they signed with North Atlantic Airways. So this is an important one coming in for the company. This is why the lease was signed. March 1st, 2025 is when the airplanes will be functional. So they had started on March 1st for the company, and July is when they're going to be starting this long-haul destination. Now, Citi on the back of this has given a buy rating as well. Target price of 5,200 rupees per share. Do not forget, Interglobe Aviation in the last couple of years had signed a lot of international tie-ups, especially expanding their presence in the Europe area. This is the first ever long-haul destination. So that is why we're expecting a positive for Interglobe Aviation.
All right, Vinny, thank you very much for that. Vamakshi is now here to talk to us about Bharat Electronics, BEL, and Quality Power, recent listing. Vamakshi, morning.
Well, good morning, Prashant. Bharat Electronics will be in focus because they've gone ahead and announced that they've received orders worth 577 crores since February 20th, 2025. With this, their total order received by the company in FY25 so far now stands at 13,724 crores. While this does bode well for the company, keep in mind that the company had given an order inflow guidance for FY25 at nearly 25,000 crores. So we'll have to wait by and see whether or not the company manages to achieve that guidance. But overall, given this development, going with the green for this counter. The next stock that we'll be watching out for is Quality Power, a recent listing, going with the green for this counter because they've gone ahead and acquired 51% stake in Meru Electricals through a share purchase agreement they had signed back in April 2024. Keep in mind that the total consideration is 120 crores. This is a cash consideration. 3 crores was paid in advance at the time of signing the share purchase agreement, and 117 crores was raised through their IPO. So therefore, total consideration of 120 crores for this acquisition. Keep in mind that this acquisition will enable the company to manufacture instrument transformers till 400 kV. This will also facilitate the company's expansion into new verticals and geographic markets, which include Southeast Asia and Africa, where Meru Electricals has a very strong presence. So going with the green for this counter as well.
Okay, all right, Vamakshi, thank you very much for that. And let's now head to Vinny. She's also watching out for a couple of names this morning. Vinny, happy Friday.
Happy Friday, but yes, a happy Friday surely shaping up for these stocks as well. I'm talking about Brigade Enterprises first. Green expected on the screen for this one. They've launched a premium residential project, and this is in Chennai's IT corridor. Revenue potential of around 1,700 crore rupees. So keep an eye out on this one. Biocon, we're expecting green here as well. Biocon Biologics and Civica Inc. have collaborated to expand insulin aspart access in United States. Now, in this agreement, Biocon Biologics will be giving its drug substance to Civica, which will use it to produce insulin aspart. Now, do not forget, Biocon Biologics also has its own insulin aspart, which it is looking to produce as well in the biosimilar front, and they're already under review with the US FDA. So that is an important one. Insulin aspart has a market around in the US of around $651 million. This is only the US market I'm talking about. And the recent launch of insulin aspart had come in from Sanofi. So it is important to watch out for Biocon, and green is what we're expecting, given that there is more tie-ups coming in and its own production as well. RITES is the last one we'll talk about. 28 crore order win is what they've got, and this is for Hyderabad, Bangalore, as well as Hyderabad, Chennai high-speed railway corridors. And the project is utilizing advanced LiDAR technology, which moves, overall the company as well as India closer to realization of bullet trains. So that is the project that of the one, 28 crores. Keep an eye out, RITES, green expected here.
Okay, all right. Thanks a lot for that, Vinny. Well, let's wind this down with Vivek, who's here to tell us with some more stocks and news. Morning, Vivek.
Well, good morning. Quite a few stocks in focus on the back of news flow. First on the list is Power Grid. The company has once again emerged as a successful bidder under the tariff-based competitive bidding scheme to establish an interstate transmission project. And this is going to be done on a BOOT basis. That's a build, own, operate, transfer basis. Now, this particular project involves augmentation of transformation capacity. This is in the state of Andhra Pradesh. The other stock in focus is Kalpataru Projects. The company has received orders worth over 2,300 crores. Now, orders have been received in the T&D segment, in the overseas market, as well as a building project in India. With this, the YTD order intake of the company is now 22,500 crore. Remember, the order book at the end of Q3 stood in excess of 61,400 crore. And lastly, Gensol Engineering, again, a lot of churn over there. The CFO, Ankit Jain, has resigned effective March 6th. That's yesterday. The company has appointed a new CFO, who is Mohan Medra Aga. And along with that, there are also reports from Mint that states that IRDA has indicated that the debt repayment has been delayed by up to 2 months and not what the company was saying, which was just a minor delay. So more woes as far as Gensol is concerned. Remember, 3 consecutive trading sessions, the stock has seen the lower circuit.
Okay, all right. Thanks a lot for that, Vivek. Well, let's move on then. The government of India has granted Navratna status to IRCTC. Mangalam caught up with Mr. Sanjay Kumar Jain, the CMD of IRCTC, to understand demand trends and what does this achievement mean for the company. Let's listen in.
Grant of Navratna status indicates the performance and efficiency of the company over a period of time. Now, with the what does it mean if a company is granted a Navratna status? Is that its financial and operational autonomy is enhanced, and the board of directors are empowered to invest up to 1,000 crore or 15% of the net worth in a project. So that's how the autonomy which is granted through this status helps the board of directors to take quick decisions which is in benefit to the company and the investors.
All right. Let's ask you about, the fourth quarter itself, because the fourth quarter passenger traffic was fairly high given the Kumbh Mela. And, what's your average daily bookings been in the fourth quarter so far? How does that compare with the earlier quarters?
You see, we have a seasonal business. So whatever happening in this quarter, booking is done 60 days in advance. So our performance quarter on quarter differ based on the in which quarter we are working. But yes, I am happy to tell you that we have got highest ever booking this month on a particular day, which is more than 15,50,000 ticket booking in a day.
What about, the expectations from the payment aggregator license that you had gotten from the RBI? What is the kind of scope of operations? How can that improve your ticketing margins going forward?
You see, we are doing this I-payment only for our internal customer of IRCTC. And we have already set up a subsidiary for getting a payment aggregator license from RBI, and we have applied for it, and we are waiting for the in-principle approval by them. And but natural, our performance, if you see in this business, we are doing excellently well when we book tickets. Railway tickets, we are number one, even better than many known payment aggregators. In web booking and in mobile booking, we are number 2. Around 22% of total booking is happening through our payment gateway at the moment. Once we get the license, it can open up this business for us. In open market also, we can approach many government agencies and private agencies for enhancing our business. So, but it all depends on our getting the license from RBI.
What about tourism? I'm looking at Bharat Gaurav Trains that saw revenue jump from 28 crores in the third quarter FY24 to 65 crores in third quarter FY25. What's the outlook for FY26?
You see, in Q2 we have, when it was dipping, we told that we have certain plan, and plan will be implemented in a very nice way, and we are very confident that time also, through your channel also, that time I told it, and I'm very hopeful to get even very better results. You see, we have taken one more rake of Bharat Gaurav train because of this increase in business.
All right. And what about, catering business? The margins out there dipped from 15% to 12%. How do you plan to restore profitability? What kind of margin and revenue growth guidance can you give in the catering business?
You see, we have to improve the volume and overall revenue. And catering, we are in the spectrum of providing catering to rail passengers, where we are satisfied with not charging very huge profit or from them, to make a reasonable meals available to them. That is our idea. So we are seeing that the rail spectrum as such, there is a huge opportunity in railway. New trains are going to come. DFC is releasing capacity for introducing more number of trains. So that's how we are more keen in capturing this market with a reasonable profit.
What about, the partnerships with Swiggy and Zomato? Are we looking at more stations being added on this e-catering business? What proportion of your catering revenues now come in from these e-catering services that you give? Is this better margins for you?
You see, there also we are working on a margin of around 15%. And because ultimately who pays? This is the customer which pays. And I'm happy to tell that because of adding all these aggregators, this last 2 months we are seeing every day meal booking is more than 1 lakh per day. And I am satisfied with the reasonable margin up to 15%.
Okay, welcome back. We've got, 13 minutes to go for the pre-open session. Siddharth Khemka is with us, the Motilal Oswal Financial Services, with what he'd want you to do in terms of specific stocks, etc. Sid, we've had a nice, decent bounce, right, from the lows. And hopefully, it stays on track. The two areas I want your thoughts, one is, of course, metals. The Nifty Metal Index is up some 10% from the lows 3 days back. And, of course, oil and gas. Reliance is starting to participate. That's up about 7% from the lows 2 days ago. Just your thoughts on ideas from these two spaces, if you have any, if you like anything.
Good morning, Prashant. I think, yes, these are the two spaces which are doing definitely much better than what the market has seen the recovery. And both have their own reasons. If you look at the oil and gas space, the crude oil, Brent crude falling below $70, that's a big positive. I think if you look at some of the OMCs, that's the preferred space within the oil and gas space, given that with the fall in crude oil prices, I think the under recoveries will be under check, as well as the marketing margins that continues to remain pretty strong, currently at about 9 to 10 rupees per litre, while our expectation or forecast for FY26 is almost a 50 to 60% discount to these levels. So the a probability of a much stronger FY26 numbers for both HPCL, BPCL into FY26. That remains pretty strong. Valuations are comfortable. Price to book have again discount to their long-term averages at around 1.2 times. And even dividend yield, that gives a little bit of comfort. So within the OMCs, we like HPCL, which is our preferred pick, where we have a target price of 490. The other one is BPCL, which is also likely to play out better with a comfortable valuation. Reliance is a dark horse because a lot of moving parts, but definitely I think it's time for Reliance to start participating, for the index to move from here. The overall setup looks good in terms of the crude oil prices. So the core business will start reporting better numbers. We have seen stability coming in the retail business, plus even on the telecom business.
No, I get that. Yesterday actually, except maybe if you look at what did well in terms of Nifty stocks, right? There was, if you can have these up, Asian Paints and Cipla were the only non-resource stocks which went higher. Otherwise, it was essentially Coal India, Hindalco, BPCL, NTPC, Reliance, Tata Steel. So all from the resource space. Any thoughts at all on the other underperforming areas, banking and financial services? Not very much momentum, even despite the RBI measures. And the other is IT services. These are both largely, large FII positioning, maybe something to do with that. But your views?
Yeah, definitely. I think the RBI's actions are positive. But if you look at banks, they have not fallen that much. Again, they are not moving up in line with the markets. So I think the rate cut cycle will be positive for NBFCs, which have started participating. We like the likes of Chola, Shriram Finance, M&M Finance. I think these are some of the stocks which should participate. Banks, we like SBI and ICICI. The problem with ICICI is the valuations a bit on the higher side compared to the market, and hence I think it would be in line with the market. So in-line performance could be seen. SBI is the other one where we could see some improvement on back of the credit growth that could come back in FY26. So the biggest challenge for banks is, yes, FIs have big stake and their consistent selling. That is leading to some pressure out there. The other sector was you asked?
Banks and IT services are the other area which is kind of underperformed lately.
Yeah. So the other sector, I think so banks clearly, I think, would remain in line with the market. NBFCs could outperform. IT services are again a mixed bag. While the rupee depreciation is positive, I think the bigger concern is right now the geopolitical, the global trade tariff war that is creating uncertainties with regards to the growth. Within that, I think the mid-cap IT space, that looks good. The likes of Persistent, Coforge, where they have consistently getting orders, delivery is strong. Large-cap IT, I think, will take some time for recovery.
All right. Sid, stay with us. We're going to take a quick commercial break here. There's 8 minutes to go for the pre-open session. We are going to come back in just a bit and continue this chat. Mitesh and Srikanth also with us with technical trading ideas. Stay tuned.
Welcome back. You're tuned into Bazaar Morning Call. Well, the gift Nifty the last time I checked was indicating a bit of a softish start. But remember, for this week itself, we're up close to around 2%. And we've seen a good bounce from that 21,950 odd mark. Should you be buying this dip? Well, to help us out with exactly that, we have Mitesh Thakkar as well as Srikanth Chavan who join us on the show. Good morning, gentlemen. Mitesh, what would you do? 50 points down to kickstart trade. If you get that dip, will you look to buy into it?
Morning, Ajit. So one, I think in the short term, the trend is on the upside and very likely that we'll hit those 22,750, 800 levels. Therefore, dips should be used to buy into. The only thing is at what level do you identify to, start placing your trades? And for me, I think that level comes close to about 22,400, 420 zones, maybe 10 points here and there. So I think that's the area to buy. So if the dip kind of expands and you get a 100-point pullback, I think that's the best entry point. Or maybe you can buy, partly at slightly higher levels and try to add more around these levels. Keep a stop below 22,350, 340. And I think over the next few days, there is a very strong chance that the Nifty will head towards 22,750, 800 levels. So in that sense, as long as we are about 22,350, I think declines would be some kind of a buying opportunity.
Okay, all right, Guy. Got it. So looking for some buying opportunities. Mitesh, let's come to Shrikant as well. Shrikant, hi, good morning. So it's been a good week so far. Indices, do you have long trades, either Nifty, Bank Nifty?
Good morning, Surbi, and good morning, everyone. Yeah, of course, more or less the view is similar to the view of Mitesh. The markets may even, in case if there is any correction, then close to 22,400, 450, the market is having excellent support. It was not crossing this level, but in case if there is any fall because of today's weakness in the market, in global markets, then there we should look for taking contra bets or going long. Now 22,300 should act as final support for the market, and that should be the final stop loss for protecting any long position. On the higher side, as Mitesh said, yes, we are also of the view that 22,800, 750 is on the card, and we should look for taking some accordingly long bets in the market.
Okay, all right. Gentlemen, hold on. We'll need to take a very quick commercial break. Come right back, and then we'll get down to individual stocks that you could consider for trading today. All right, just about 12 minutes to go before we kickstart the Friday action. Let's actually, since we're talking about it, let's quickly look at the pre-open Nifty as well. About 30 points higher, cautious start. That's what we're getting. Okay, now it's flipped into negative. Now it's 20 points lower. Let's see how this goes. Otherwise, Asian markets, as we've been telling you, they've been reeling under pressure with that weak handover from Wall Street. But we've been resilient, and the bulls will hope that continues this Friday as well. All right, back to Mitesh as well as Shrikant for some stock ideas. Mitesh, morning to you. So what are the stocks you're going with?
Good morning, sir. I have a buy on CAMS if it starts trading past yesterday's high. So buy about 3325, keep a stop at 3295, look for targets of 3400. Buy on Coal India on a mild decline, say around 380, which is about a rupee and a half, 2 rupees lower from closing price. So if you get a gap down, Coal India is a buy. Keep a stop at 374, look for targets of 395. Similarly, BPCL is a buy around 262 with a stop at 257 for targets of 275. And one sell call, that's Jubilant Foods. Keep a stop about 620, look for targets of 590.
Okay, all right. Got that, Mitesh. Thanks a lot for that. I thought people be ordering pizzas over the weekend because of the match, but maybe the structure is not looking too good. Got that call, Mitesh. Thanks for that. Shrikant, what about you? Individual stock calls?
Good morning, Najat. Yeah, there are multiple stocks and number of stocks. They are crossing their important immediate resistance levels, which is positive. In that space, we like Titan, which is around 3130, 3140 sort of levels. From here, again, the stock can move to the levels of 3250, 3300, where the stock has spent maximum time. So at this level, it is forming some reversal formation on daily basis. It's a buy at current levels with a stop loss close to 3080. And the other stock which we like is Infosys. The reason is that, the dollar index is cooling off. The 10-year bond yield is also below the levels of 4.30, and the increasing chances of cutting interest rate in the US, maybe in the next few policies. So at this level, Infosys looks quite attractive. It is at its important support levels. From here, the stock can move to the levels of 1770 or 1800. We can keep stop loss at 1670 for creating any long position.
Okay. All right, gentlemen, got that point. Thank you very much. We'll come back to you a little closer to market opening. Just looking at the rates again, it is about a 70-point decline right now on the Nifty in the pre-open. So let's see how this kind of moves forward. There we go, 75 lower. 22,460 is where we are at. Well, up next, we're putting the spotlight on the paints sector. Yesterday, remember, crude oil prices tumbled. Brent is below $70 a barrel, which is a great headline. And we saw a lot of the crude sensitives rally big time. It was OMCs. And of course, within the consumer arena, it was paint stocks, particularly Asian Paints. It was a nifty winner, up almost 4% yesterday. Asian Paints so far this year is actually flat. Perhaps you can argue that it's been in a long bear market of its own much earlier than the last 6 months correction started. And the stock is just checking how much is it off its 52-week high. It's about 35% off its 52-week high as well. So is the worst getting over for the paint space? Let's ask Abneesh Roy, Executive Director at Nuvama Institutional Equities. Abneesh, great to have you on. Thank you for joining in. So what do you say? I mean, a lot of these stocks have been already battered down so badly that do you expect that bear market to start ending?
Yeah, thanks for having me. Yes, we are picking up some recovery in terms of the paint demand. In the first 9 months, the paint industry saw almost flattish volumes. Of course, in that space, our topic will be Berger Paints, not because Asian Paints, any execution issue is there. The problem with Asian Paints has been last few quarters, the urban salience. If you see any of the top metro cities, complete dominance of Asian Paint is there. And Berger is more of rural India, East India, Central India. And there the slowdown is much lesser. In fact, rural India, there is a recovery. So in the near term, medium term, we continue to prefer Berger Paints over Asian Paints. But overall sector, our sense is there is a slight recovery in terms of demand. And in terms of crude oil, absolutely yesterday's good performance of Asian, Berger, etc. Crude oil clearly is comforting. From a market share perspective, Birla Opus has taken, in our view, around 5 to 6% market share. The distribution scale-up has been good for Birla Opus, around 50,000 dealers, touching almost that. The advertising spends by Birla Opus has been high. So currently, if you see Cricket World Cup, Birla Opus is spending a lot of money there. In the IPL, it starts in the next 2 weeks. Again, Birla Opus is one of the key sponsors. So my sense is ultimately Asian and Berger Paints, if you see last 30, 40 years, they always come back. FY26, how we see the margin recovery will happen, demand recovery will happen for Asian and Berger. Berger, in fact, our sense is Q4 itself will be high single-digit volume growth for Berger, but Asian will be still maybe 3-4% volume growth in Q4. But FY26, how we see is basically gross margins will improve because of the crude oil, but I think the ad intensity for the sector will remain in FY26. That will remain.
That was a lot of numbers, Abneesh. I'm just trying to write this down. You said 3 to 4% volume recovery or 3 to 4% volume growth for Asian Paints in Q4. Berger, yes, which is the one that you like, what's the volume growth expectation you're going with?
Yes, absolutely. We like Berger. Our sense is 8 to 9% volume growth is possible for Berger in Q4. Yes.
8 to 9% volume growth in Q4 for Berger. That's much better than Asian. Simple question. Now let's talk FY26. Overall, what is the volume growth that you will pencil in? Who will be at the lower end? Who will be at the highest end? Will it be Berger? And then that valuation question comes in. That, I mean, if Asian is going to deliver, say, 5% volume growth in FY26, do you still want to buy that at the current valuation multiples? So, juxtapose the valuation argument on the growth argument for us.
Yes, definitely. Our sense is Asian Paint should be able to deliver 5% kind of volume growth because we are picking up some recovery in terms of the demand. The base also for Asian Paint does become favorable after Q1. The urban slowdown, which is impacting Asian Paints currently much more than, say, Berger. Our sense is from Q2 overall, we expect urban recovery to start for the sector. Currently, it's weak for FMCG paints everywhere. Because of the union budget tax reprieve, we do see that from Q2, Asian Paints recovery will start. Coming to valuation comfort, Asian Paints is available below 40 times P multiple FY27. Our sense is that's a very reasonable, very tempting valuation. And we do see that FY26, we will see the re-rating start for Asian Paints. It has the reasons for crude oil, the recovery in demand definitely. And ultimately, our sense is Kanza and Akzo are at a greater risk of market share loss. Structurally, we will monitor what happens on Akzo. Our sense is JSW is the front runner and Pidilite also could be a very serious contender. That is one more thing we'll watch out for.
40 times, guys, you remember the last time we said 40 times for Asian Paints in terms of forward earnings? So you're saying FY27, actually 40 times. I don't remember the last time the number 40 was used with Asian Paints when you're talking valuations.
Absolutely. And yeah, that's the thing with the market, right? I mean, 70, 80 has become 40, but 40 is 40. So it's a conundrum in that sense. Avnish, you track some quick commerce names as well, right? That space?
That's tracked by another analyst, internet analyst, but there we like Jubilant Foods a lot. And even in Avenue Supermart, my sense is today also, if you read, Zepto is focusing more on the profitability, increasing the charges, etc.
Oh, there is an article. I was trying to, I don't order that much, I mean, but I was trying to order something yesterday, and all the discounts were like on Zepto, they were all like 2 rupees, 1 rupee discount, 5 rupee discount. So the big discounts seem to have disappeared. But I was not sure, since I'm not a regular user, maybe they've already been gone for a while. But if you're saying there is something to that effect now which says they've lowered, and Zepto has been the competitor, right, which has been putting pressure on others as well, not to be able to sort of up their game and focus more on profitability. So if they stop discounting, good for the overall sector from a market point of view.
Yeah, it should be. If you see even comments by Zomato that the big disruption is by Zepto, yes, I would expect that. But in the discretionary space which I cover, I like Jubilant Foods. I do like Trent, V-Mart and Titan. Those will be my coverage names. But yes, we are picking up that because of the overall market meltdown, focus on profitability, I think the discounting, etc. should come down, which is also positive for FMCG larger players, that ultimately it's about product innovation and distribution rather than just discounting.
Yeah, I can tell you, Prashant, as a recent Zepto users, they're getting smart about it, and actually they're saying that as well. I think, a bunch of our colleagues were speaking with Karan Torani, as you guys were speaking with Karan just a while back, discussing quick commerce, and I've seen that as a user. The discounting is now being clubbed with large value orders. So above a 600 whatever
Super Save or something, which is only eligible on 700 rupees.
There's a minimum order value, so they're getting a little more tactical with their discounting.
I wasn't sure whether this is less discounting, more discounting.
It was confusing. It was very confusing for
But I was surprised to see proudly 1 rupee discount, 2 rupee discount on 200, 300 rupee items. So I thought maybe they've actually lowered it a little bit. Thanks very much, Avnish, for joining us. I think we're about 3 minutes away from market open. We'll continue this chat with more in terms of what you cover, what you like. But 9-10 calls, Mitesh is with us with what he'd want you to do. Mitesh, 9-10 calls?
I'll go with a buy on Coal India for targets of 395.
Sudarshan, what about you? Okay, I think Sudarshan a little later, but those are the calls coming in. 3 minutes to go for the market open. Sud is here with what brokers are saying this morning and what they're focusing on. Sud, morning.
Morning, Prashant. So I have 3 stocks, but we'll start with Reliance Industries, where there is another positive brokerage note. Macquarie has upgraded the stock to outperform with a target of 1500. It has upgraded, expecting few positive incremental positives over next 6 to 12 months. And now it says that FY25-27 EPS CAGR is seen at 15 to 16% against 2 to 3% in FY23 to 25. Now, few catalysts. First, better earnings momentum, potential geo listing, and gradual commissioning of new energy capacities. Another stock is Nykaa, where UBS has upgraded the stock to buy with a target of 200. It says beauty and personal care segment continues to surprise positively. And second, there is a significant EBITDA losses have come down in the fashion segment. And now it says that stock is trading at FY27 EV to EBITDA of 42 times versus consumer sector average of 25 times. And it expects FY25-28 revenue CAGR of 24% versus consumer sector average of 12%. Last one is PVR Inox, where Kotak Institutional Equities has upgraded the stock to buy, but it has cut target price to 1200. It says stock has declined in past few months on weakness in box office collections, but it is positive on Hollywood collections. Also, it says the initiatives on cost optimization, capital light expansions are noteworthy, but it has cut FY26 to 27 EBITDA estimates further by 3 to 13%.
All right. So thank you very much for that. So PVR, Inox and Reliance, of course, more calls coming through. We've got a couple of minutes, a couple of seconds to go for the market open, and we'll have the first rates up on your screens shortly. What do we have? Just counting down, and we should be able to get on with it, with the Nifty, the Bank Nifty, and of course, sectors, etc. before we look at stocks. So it's lower as the pre-open, the GIFT Nifty, etc. were indicating, but not that much. Slight pullback, 22,500 basically on the Nifty. The Nifty Bank is down about 0.25%, 48,500. And you've got a sensex down about 0.25% as well. So uniformly 0.3% cuts to begin the day. Advanced decline, broader markets have been steady. Actually, I would say they've been steadier as compared to the Nifty or the large caps. So 923 up and about 400 lower, but stocks are still opening up. Mid-cap index is down about 0.25%. Actually, even yesterday, the mid-cap index was down. Small-cap index ended higher. Small caps outperformed mid-caps. Small caps are flat. Actually, they're in the green again, while the mid-cap index is clearly down. So there's a divergence even there. So the smaller stuff is doing better as compared to mid-tier names. And I saw the micro-cap index, even smaller, that also was up sharply yesterday in terms of rebounds. The Nifty heat map is coming up on your screen, more down than up, certainly 30 down, 20 up, approximately 65 down for the Nifty to begin the day. Surbhi.
Okay, let's take a look at some of the movers and shakers on the Nifty. 57 points down, so I'm looking at the ones that are taking it lower first. Infosys, Tech Mahindra, HCL Tech, TCS, it's that, NASDAQ effect perhaps that's playing out. Just weak US tech, general weak sentiment around tech in India as well. And then there are some big boys like HDFC Bank, ICICI Bank. So even the banks are not feeling that great this morning. So IT and banks on the back foot. That's pretty much it. I mean, beyond that, a little bit of selling on ITC or Mahindra and Mahindra. But then let's talk about the green side. What's bouncing higher smartly is HDFC Life, 1.5% up. BEL is positive. There's some buying on names like Bajaj Auto. Reliance itself is a big support this morning, 0.5%. It's an excellent counterweight to the selling that we're seeing in IT and banks. There's Coal India, L&T. So it's very, very evenly poised. I mean, it's absolutely net neutral, which is why the Nifty is now just about 5 points lower. So big fight back. And while IT and banks are a little subdued, the others are coming to the rescue. Let's see, maybe the Nifty. Yeah, Nifty's suddenly flashed green. It is green now. So the bulls are making their presence felt.
Well, that's right. In terms of stocks that are moving lower on, large volumes, I think PI Industries, that stock is down close to around 5.5% or thereabouts. Kumai will be declaring its numbers today, and we'll be waiting for some commentary on that front. I'm not sure whether the numbers are already out, but Kumai is the one that's going to be coming out with numbers, and Pyrozar Sulfone is the one that we normally track in terms of commentary. So we'll keep an eye out on that particular stock. Besides that, stocks that are moving around in today's trading session, you have a couple of big winners. Kalpataru, if I saw that correctly, that stock in fact was well in the green because of their order win. So good going out there. A couple of other notable movers in terms of winners today. You have Khadim, not very high volumes out there, so we can avoid that one. But as we were doing that market check, actually, the markets have moved well in the green, from a 60-point downtick. So the first dip has got bought into, which is good news. Since the dollar index is softer, we have metals that continue to do well. Hindustan Copper, I remember the stock went to around 400 rupees, then it halved to around 200 rupees. That's the pure play, on LME copper prices. So that one, in fact, has moved up. Quest Corp, they've got that nod, I think, for the demerger, splitting of businesses. So that one as well as holding in the green. And Z Enterprises, as we had mentioned yesterday as well, the promoter entity coming in there, buying some shares after a long while. The stock is up close to around 2%. And keep your eye on Geo Financial as well. Volumes fairly good in the first few minutes of trade. Stock up close to 100%, but volumes very, very high. From the lows of this week, the stock is up more than 10%.
Are they coming? Are they coming in the distance? Can you see them? Can you see them? The FBI.
Okay, well, flattish now, so that's a pretty good outcome given the overnight screen. And that's the thing, right? Markets here paid the price, at least to some degree. And the US, of course, is maybe just about starting its correction. I think the S&P from the highs is now down about 6% or so. NASDAQ is down something similar. Here, of course, we've had 16-17% falls already from the highs. So there's a bit of a lead lag. But these are the two markets which have been tightly correlated over the last 3 years or so now. I think best performing large markets for basically 3 years in a row. What else is going on? Maybe we can look at some of the other big movers which are coming up. maybe just look at the IT index, IT and the Nifty Bank. These are the two underperforming sectors. And see if IT is still down. IT is down 1%. So that's being bogged down. And that's a large weighted sector. And the Nifty Bank is down as well. So, you know, just see through the course of the last 3 days when the markets have bounced, these are the two sectors which have bounced perhaps the least, between 1.5% to about 2.5%. Everywhere else, there has been sort of more enthusiastic recoveries as we've seen. Nigel?
Yeah, no, just wanted to point out Reliance Industries. We pull up Reliance Industries with the 20-day MA. The stock is actually very, very near to that. It's at the 20-day MA. So Reliance Industries, that's the one that's bounced back a little bit from the recent lows. It's been a relative underperform over the last few months or so. But now brokerages are getting constructive, both on the valuation parameter and the triggers going ahead as well. And as we speak, spot on, Reliance Industries is now at the 20-day MA. The other one I'm looking at is Gensol. The negative news flow continues. The CFO as well had resigned. But take a look at the stock. From the lows of the day, actually, the stock is up close to around 10%. So the last few trading sessions, it's been at lower circuit. Now volumes on the NSE I checked were close to around 15 lakh shares. Pull up Gensol. From the lows of the day, the stock has seen a sharp recovery. Last few trading sessions, the door was shut. You couldn't get out of it. Volumes are very, very low. But as we speak, I think that's the BSE volumes. On the NSE, the volumes are far higher. So keep an eye out on that one. I think the intraday chart will give you a better picture. And REITs will be getting the management with us, in a short while from now. That's one in order. That's up close to around 4.5%. So good move on that one as well. And Kalpataru Projects, now that one is screaming away, up close to around 6% or thereabouts. So it's a good start. Hopefully by the time we wind up, it'll be as good, particularly the breadth of the market. 3 stocks advancing for just 1 stock that's declining.
Okay, so yeah, I mean, some more names on the gaining side. The only issue is volumes. I mean, how many of the stocks really have reasonable volume? Some of the consumer names like a Barbecue Nation moving higher. There's Aptech. Haven't seen this stock in a long time. Market cap is up 1,000 rupees now. That's up. Kalpataru Projects, obviously, because of the order wins they've announced. Smart order wins, over 2,000 crores of additional orders.
On Aptech, there was a large trade yesterday. I'll just try to get further details, but there was a large trade yesterday, so I'll just check out what exactly happened.
That makes sense, because, we haven't seen it come up on the price and volume charts in a while, 7%. Today, Interglobe Aviation is not quite flying. They're going to Amsterdam and to Manchester, long haul. Stock's not flying this morning. It's far more mutish and flat. And Hexaware, of course, the management will speak with shortly. First numbers coming out after their listing, should I call it relisting, basically re-entry on the street. The growth is fairly anemic, 1.2% constant currency terms, and we'll get an outlook with them going in a bit. But let's put the spotlight on Reliance now. We have Sudarshan joining, and I think he's looking at some reports and some data. So what's happening?
So in the last 2 days, we saw 3 positive notes on Reliance Industries. Yesterday, we saw that Kotak had upgraded the stock to buy, and even Jefferies had maintained buy. And both Kotak and Jefferies had increased their target price. Kotak had a target price of 1,400. Jefferies had a target price of 1,600. Now today, Macquarie has come out with a note. It has too updated the stock to outperform, and now its target price is 1,500 per share. So somewhere implying an upside of around 20% from current levels. So what does it say? It says that it has underperformed MSCI India by 18 percentage point and underperformed Bharti Airtel by 60 percentage point in last 1 year. Now, why it has upgraded the stock? So basically, it's expecting few incremental positives over next 6 to 12 months. Also, it says that FY25-27 EPS CAGR is now seen in the range of 15 to 16% versus mere 2% over FY23 to 25. What will be the key catalyst as per Macquarie? First, better earnings momentum. Second, potential geo listing. And last is gradual commissioning of new energy capacity. So on the back of these positive notes, yesterday we saw an uptick of almost 3% Reliance Industries, and even today it's higher in trade.
Okay, all right, got it. Thanks very much. Explains that move on Reliance and Sudarshan. Let's now talk about Hexaware, the stock that I was just discussing, which is down about 1%, Those numbers came through. Let's do a deeper dive with Rima. So, Rima, just 0.2% top line growth, right?
Indeed. So just 0.2% in Q4. But remember, Q4 is a seasonally weak quarter on account of furloughs. And the management just held their conference call. And in that, they were indicating that some uncertainty has emerged in macros in the last 2 to 3 weeks. Prior to that, things were looking a lot better. And the sectors they're going to watch for would be manufacturing, consumer, because here there would be a first order impact of Trump's tariffs. So some uncertainty has, crept up. So which is why this time, unlike, a couple of years back when the company was listed, they used to perhaps give you a numerical guidance. They would say that this year we're going to grow at 10 to 12%. This time, all they're saying when it comes to the outlook is that the performance will be resilient to modest macro changes. But of course, if the macro gets worse, then, it's everything gets, thrown in. In terms of Q4 numbers, constant currency revenue growth was just about 0.2%. The company managed to expand margins in Q4, and that's because Q3 was a wage hike quarter. So Q3 margins were depressed. So on that lower base, margins have expanded by 30 basis points. For the full year, calendar year 2024, the company's clocked in a top line growth of 13.5%. But there are a few positive, sound bites coming from the management. One, they're saying 2 out of their top 3 customers are going through consolidation, and the company has won those deals, which will ramp up Q2 onwards. And secondly, 2 significant deals, consolidation deals, are in the works. If the company wins, then growth will pick up in the second half of the year. So the outlook is a little more uncertain, but the company's performance is likely to be resilient in the face of that. Back to you.
Okay, all right, got it. Riman, thanks very much for the inputs over there. By the way, the market's turned, so there is some volatility. It's not an uptrending start immediately from the word go. That flat line has now again become a 40-point downtake, and there's about a 0.25% decline on the mid-cap index as well. The bank nifty is the one that's the problem point. Remember, we told you that it was IT stocks and it was banking stocks that were leading the decline. The bank nifty is now down about 0.4%. Some of the key names include ICICI Bank on the way down, IndusInd Bank, Kotak, HDFC anyway was weak. So this is where the problem is. I just want to make one more point on the overall Asian picture this morning. Asian markets are showing a lot of divergence. So remember, we had this huge weak slam dunk from Wall Street. Asia is taking it in a very different way. The Chinese markets have moved higher. I was about to say that our market has also marched up, the Asian giants, China and India. But now we're kind of wobbly. Japan is underperforming big time. The Japanese market is down about 2%, and that's because their currency is surging higher. Obviously makes exports that much less competitive. So that rising currency is a problem for Japan. They're anyway going to go through a rate hike cycle as well. So Japan is slightly different. But China's doing very, very well, and we have been doing really well, and hopefully, green will be our color in the next couple of hours.
No, I think, Surabhi, there's only one market to watch in Asia, that's China.
Yeah.
I mean, except us. Because that's essentially what is, things are happening, things are moving, and after many years, there's all this AI, the tech prowess is essentially being displayed very, very strongly. And it's a clear divergence, right? 0.5% higher. Hang Seng was up, and this is after 3% yesterday. And of course, I mean, a pretty decent run that market has had this year. And
also, money doesn't wait for certainty, right? It can't. That's the nature of markets. Yeah. So while the US figures out if those tariffs are staying or if they're getting rolled back, and what is the impact on GDP, is it 0.5% or is it 1%? Money is not going to wait. Money is getting maybe 5% growth, about 5% in China, hopefully 6% plus in India. And we're only hoping that money is moving. It's definitely moving to China. That's what I'm saying. I'm looking. Maybe they're coming. The FPIs.
No, I think the other thing to consider is that, the weekend, there's always news flow risk, etc. But now with Trump, I mean, that risk is, remember what happened last weekend, right? There was that, it was, of course, not big for India in that sense, but there was the Zelensky fiasco. It turned into a shouting match in the White House. So who knows what the weekend brings. Usually we go to sleep, come back the next day, so there's one-day risk. But here you got 2 days, Saturday and Sunday. And I think with this amount of staggering news flow, it really becomes real. For if you're trading, I mean, you don't want to carry positions, into the weekend, especially not at a time like this. And I think that's at play as well. 36 points lower, 22,500 is where we are at. Lots of stocks are moving around. We'll address more of these as we go along. But I think we have our first corporate interaction, ready with us in just a bit. I think I just want to mention just one thing. Gensol is coming up, is the second largest volume-led mover right now, and it's up 1%. I saw it being up 4%. It was limit down, lockdown. It's up 1%. I mean, rating agencies essentially saying documents were falsified. We had the management with us, CFOs resigned, 340 or so. So that's a story which we will continue to follow. Otherwise, a little lower this morning. Nigel, the rights management is with us. Okay, I think...
we have Mr. Rahul Mithal, the Chairman and Managing Director of RITES. He's actually with us in the studios. Mr. Mithal, great to have you in person with us. Thank you so much for joining in. So we want to look beyond the third quarter, and the third quarter was obviously not the best for RITES because most things were down. I'm just looking at the numbers right now. We'll put them on the screen. About 15-16% decline in top line. Margins fell quite a bit. And it seems your high margin business, that's where maybe there was a delay in execution. I'm not quite sure. But you tell us if execution is looking better in Q4 and what can we expect?
Yeah, morning. I think, yes, you're correct. The Q3 and the previous quarters also, this 9 months, the aim was to try and execute the existing orders and have an aggressive growth in the order book. And the key hit was because we didn't have any export orders for last about 3-4 years. The orders started flowing in the last 3-4 quarters. And these will start generating revenue by early next FY, so Q1 of next FY. Another hit was the quality assurance business of the Indian Railways, which opened up on a competitive basis. So if you see the 9 months, there's a total hit of YOY of a top line of about 200 crores and the bottom line by about 80 crores. So that's the huge hit. But moving forward, the aggressive order inflow that we've got and improved execution would see a sequential improvement. And that's what's been happening if you see Q1, Q2, Q3.
Your order book is around 8,000 crores, right? That covers you over how many quarters? And what is the addition that by the end of this year, where should the order book be?
So you see, this quarter has been an all-time high. We got 110 plus orders totaling to 1,900 crores, which is a huge jump. In fact, this quarter, the 1,900 crores is nearly equivalent to the entire previous FY of about 2,200 crores. So 8,000 crores order book roughly covers about 2.5 years. And with this level of order inflow, we are aiming to cross 10,000 crores in at least the next 2 quarters. And we are maintaining that strike rate, that milestone, which we achieved about 4 quarters back, of being a 1 order a day company, 1 order a calendar day. So we maintained that strike rate even in this Q3. And we are sure that we'll be able to maintain this in the coming quarters.
Well, kudos to you and the team, sir, with regard to the order wins. So well done on that front. What the stock market wants to understand, your investors are waiting for is execution.
Yes.
This year, as you warned earlier, that it's going to be a bit of a subdued number in terms of revenue, and there'll be a bit of a degrowth for this year. So what are you planning on ending this year with in terms of revenue? Point number 1. Point number 2 is on that depressed base, I think you were guiding for 20% growth on revenues. Is that on for FY26? And margins will hold in this 20-21%?
Yes. So in terms of 9 month to 9 month, we were down by about 11% on the top line and about 25% on the bottom line. As I said, the execution has been improving sequentially.
Right.
And what we are aiming is that we end the year at least to try and bring down the top line dip to about 10% or below and bottom line dip to about 20% and below. And this guidance of next FY growing substantially, at least 20% on the top line and at least 10% on the bottom line, that remains because with this order inflows coming, with the way they are coming, even in the Q4, which has happened about 1.5-2 months, we are sure that these orders will start generating revenue next year.
Give us your take on the competitive intensity, because exports, that's the one I think where you get a higher amount of margins. But I believe competitive intensity there as well has gone up, and that's why the margins have come down. So could you comment on that, on the exports? And also the Indian Railways, I think the contribution has come down a little bit. Where do you see this number stabilizing at? And comment on the competitive intensity out here as well.
So that's a huge change in our business scenario, quarter and quarter, every passing year. In fact, this quarter that we ended, 60% of our order book is on the competitive basis. And even in the export line of business for the last 5 decades, all the orders that we had got were on the line of credit export business. This was the first time in these last 3 quarters that all our export orders are on a global competitive basis. So even the Bangladesh order for 900 crore, that's a global tender. So obviously the margins have dipped and will dip even in the export stream of revenue. So moving forward with the increase in all my streams of business in the percentage of competitive orders, the margins are settling down in this range of about 20-odd% EBITDA margins and PAT margins about 15-16%.
Mr. Mittal, government share of government orders are, what would it be, I mean, as you go forward, as you look ahead? Because that's been coming off, right? From 60%, that's now about 40-odd% or so. I mean, government business. So it's more and more dependent on the private sector in that sense?
So you see, our USP is that we have all areas of infrastructure consultancy except oil and natural gas under one roof. We have 13 different verticals. And as more and more big private players come on to, infrastructure areas, whether it is ports, airports, buildings, highways, etc., we are being able to tap them. And that's the reason, if you see the overall mix, while the orders are coming in from all quarters, but in terms of the ratio moving, if you compare year on year also, the ratio of private orders is also increasing. And I see that happening even sequentially and even in the next FY.
But will that sort of, and the government side, the orders are on a nomination basis, it's competitive bidding. I mean, how does it work?
No, in fact, even on the government side, whether it is the central government ministries, state government, or PSUs, other PSUs, many of them have a competitive bidding, or sometimes based on our experience and credibility and our credentials, we also give they give us orders on a single tender nomination basis. So there is a mix of both. But last year, the ratio of competitive to nomination was about 50-50, or in fact, the nomination was above 50. And this quarter, as I said, when we have ended with an order book of 60% competitive. So that's continuously changing, not only the ratio between competitive and nomination, but also the ratio between government and private clients.
So, Mr. Mittal, what I'm trying to understand is you said that margins on a going forward steady state basis should be at about 20%. 20% is a new normal, which is lower from where you've been. Is that because in the portion which is competitive bidding, the competition is really high? Or is it because there's some issue with your higher margin business? And what is your premium margin business? What is your low margin business? If you could just explain, why is 20% this new normal?
So, you see, the main reason is because 2-3 key streams of business, as you correctly said, which were traditionally high margin areas. For example, export of rolling stock, which was always a high margin business, about 20-25% range margins. And these were, as I said, line of credit orders. So you had primarily lesser competition. Only Indian companies could bid for that. Now you're participating in global tenders. This 200 coach order is a global tender. So obviously the margins in that stream have gone down.
So it's getting very competitive.
Very competitive. Got it. The second, another very high margin stream of revenue was a quality assurance vertical, which was doing business on a nomination basis for Indian Railways, which accounted for about 60-65% of this revenue for last 5 decades. Now that opened up about 1.5 years back through 4 players on a competitive basis. So the pie got divided between 4 players. And the rates also came down. So that itself, in 9 months, that has had a hit of about 50 crores on the top line and also on the bottom line. So areas of high margin streams of revenue have not only opened up, so that's taken an overall hit in the overall margins.
So places where you had monopolies, strong monopolies earlier, now there are other entrants that have come in. So margins have come down to 20%, and that looks like the new run rate. It's a new reality that investors have to deal with. So one can only hope that your top line makes up for it. More orders, more wins, better execution, and better, CAGR top line growth. I think you've given us some estimate of what the new year will look like, but, what can we expect? Can the top line growth look better than where it historically has been on a going forward basis?
Exactly. So because of this reason, our clear strategy was not only to improve execution in the existing orders, but have a very aggressive order inflow. And that's why we targeted 1 order a day. 5,500 crores was the closing order book on 31st March. We are now at 8,000 crores. We are targeting 10,000 crores in the 2 quarters. So moving forward, our highest ever revenue has been about 2,750 crores. Moving forward, we are aiming to definitely cross that. We are aiming for 20% growth next FY, even on this lower base. So as you correctly said, higher order book, faster execution will take us past the previous highs.
Mr. Mittal, have the internal changes have all happened over the last 1.5 to 2 years? Because now you're in the marketplace for orders. You've got to, the nomination side is, the pie is lesser and lesser. So, and you're dependent on the private sector. I mean, you know, this capex cycle, whether it'll come back, not come back, whatever. But internally, are you all set, prepared for, you know, to go out there and get orders in that sense?
So, in fact, two things. One, in terms of taking a conscious call, because when you're going for aggressive order inflows, and in consultancy, the minute you get an order, you have to deploy people on the project sites. So, even though this was a tough year and we knew that we were going to be lower than last year, we took a conscious call. We've inducted about 300 people in the last 1 year because we know that these orders will start getting and they will require people, you know, deployment on the site. So that's in terms of fresh taking in resources, and we are already continuing with that. Another about few months, definitely we're going to take at least 100 people more. And internally, more and more getting, you know, adapting and becoming more agile to competitive bidding, both domestic and international. We recently got an 80 crore highway order in Guyana through a global competitive bidding process. So that's just making us more and more agile. So it's a two-pronged strategy: internally agility and taking in more resources to, you know, be able to tackle these aggressive orders coming in.
We wish you all the best of luck, Mr. Mittal, to you and your team. And thank you very much for dropping by to our studios. Appreciate it.
Thank you.
Well, thanks very much. We'll take a quick commercial break here. We're going to come back in just a bit from now with a quick check on markets, of course, which are down there. I mean, 30, 40 points, 50 points lower now. But the next management also with us, that's Hexaware, recent listing, because it's in a way, it's a relisting. Hexaware Tech to discuss their numbers and, of course, the outlook going forward. We'll have the CEO and the CFO join us for that chat. Stay tuned.
Well, Hexaware Technologies reported their past quarter's numbers. The company expects this calendar year to be resilient. To discuss that and more, we're joined by Mr. Sri Krishna, as well as the CEO and Executive Director, as well as Mr. Vikas, the CFO of the company. Hi, gentlemen. Good morning, and thanks a lot for joining in. Well, you'll have given some commentary with regard to this year, and you're expecting things to progressively improve Q2 and then Q3. But you'll have not quantified it. How much better can calendar year 2025 be in comparison to 2024? If you could give us a rough range as well, will be good.
You know, we coming back to markets after a while, and we've decided consciously not to provide a guidance. But I think there's some color and commentary that is valid. We are very confident about what 25 looks like. You know, we've specifically said investors should not get worried about the news cycles and the macro changes that is led by the administration in the US. Our business and our order flow is resilient to that. We have 2 significant consolidation deals in 2 of our top 3 clients, which the ramp up is expected, like you said, in some in Q2, majority in Q3. And there are 2 more such deals in the offing, which, you know, we may or may not win, but even if you win one, it'll actually portend a very good future for us. Our expectation is to do better than the past. You know, if you look at 24, in a difficult year, we did 13.7% growth. Most companies in our industry, vast majority, were in low single digits. Materially outperformed the industry, and I expect that we will continue that outperformance.
Okay. All right. So, at least 13%. Gentlemen, good morning. Prashant here. Mr. Jain, at least 13% is what Sri Krishna is telling us?
I mean, as Keech called out, we are not giving any guidance, but we are giving.
Okay, so that was my question, because
which indicate, yeah.
Yeah, that was my question. Why not? Because is it simply because is it tougher to give a guidance because it's, and I completely understand things are in a bit of a flux and changing all the time now, at a much faster pace than when you were actually first listed in the markets, right? The first time around. Is that the reason, or is there any other reason?
So, no, actually a reason for not providing guidance is not here and now.
Okay.
Our temptation for the current year is to provide a guidance. There's a lot of confidence. But not providing a guidance is keeping in mind the next 10 years. We'll go through a lot of different cycles, so we think it's best that we don't provide a guidance long term.
So things are, you expect things to change significantly. And you'll have to sort of pivot to those changes. Is that the way to look at it?
That is correct. And we've done that successfully always, and we will continue to do so successfully. We just think it is good practice to kind of provide enough indicators, confidence about a business that we are.
Sure.
But stay away from actual guidance.
Okay, so you're steering away from actually putting a number to those expectations. Got it, gentlemen. I just want to talk about the update that you've given with respect to future deals. You said that 2 out of your top 3 customers are going through consolidation. Those are deals you've won. You've also said that there are 2 more significant consolidation deals in progress. Can you give us some sense on how large these deals are? What's their nature? What are the sort of margins they come with? Vikash, maybe if you could take that and give us some more color on by when does this start showing up in the P&L? In Q4 itself, the next quarter itself, or will it take longer?
So just wanted to clarify one thing, that the year that we follow is calendar year. So it's Jan to December. So the results that we came out with was Q4.
So it will be Q1. So exactly, whether these deals will come up then in Q1 or, otherwise it will be Q2, calendar year
no,
Q2
it will
for
start,
you.
It will start, so it will start reflecting from April to June quarter onwards, so which is Q2 for us. So you'll see that the deals will start ramping up from a Q2 perspective, but the full impact of that will get reflected from Q3 onwards, which is in the second half.
And what's the size of these deals? These consolidation orders as you described them?
So these are large customers, from both perspectives. One, they're large for us. These are very large companies with very large spends. And they are reducing the number of people that they're distributing that spend with. So the incremental spend on take is material, but they're not in the form where they've said, hey, this much goes to person A and this much goes to person B. It will evolve over a 2-3 quarter period, but it'll be significant.
Okay, all right. I wanted to focus on a couple of other aspects. Europe, I think, is close to around 18% of your total mix. And actually, that's been growing at a slower pace in comparison to the overall business. However, the sound bites that are coming out of Europe in the recent past have been quite positive. Do you expect Europe to do relatively better from this year on? Are those the signs that you're getting? And also, margins have been in the vicinity of close to around 16%. On the profitability aspect, do you think there is scope to improve from year on, or will it stabilize at these levels? Europe as well as margins. Please go ahead.
On Europe, if you zoom back a little bit, our performance for Europe has been very good. In the last year, it slowed down, and you're right, the expectation is along the lines you said, that it will improve. It will improve back to at least company average in 25.
On the margins, you're right, we are going to be improving our margins very meaningfully from here. From a full year perspective, we reported a margin which was in the range of 15.9%. Operating margin EBITDA, we expect that to improve to 17% plus in 25, and it will further improve to 18.5 to 19% over the medium term of 3 to 4 years.
All right, I had more questions, but we're out of time, gentlemen. Thank you very much, and hope you come back again, and we can continue this conversation. Thank you very much, and good luck as you sort of look ahead into the rest of the year. Rahul Jain is co-head of Asia Financials and head of India Equity Research at Goldman Sachs. He's with us now to take some questions. Rahul, great to have you with us here. Thank you for your time. So the market seems to be bouncing a little bit. But the one sector, prominent sector, which is underperforming in this, I'm talking about very, very recent markets, but from the lows last 3 days, is financials. And this despite the fact that the RBI has come in again with maybe, according to some, a larger than expected boost to liquidity, replacing durable liquidity in that sense in the market. So what's the top bother in that sense, Rahul? A sector which is widely acknowledged as cheap and has not performed for a number of years, reasonably valued in that sense. Go on.
Thanks, Prashant, and good to be back on your show. Before I take a deep dive into your question, let me just paint the overall picture the way we see it. Last year, we called out that the Goldilocks period was over for the financial sector in India. And this year, we called out that there could be a muddle-through scenario for the sector because the earnings still continue to face the headwinds emanating from all the three factors that we're possibly seeing out there, which is asset quality. You all would be seeing what's happening in microfinance space due to Karnataka ordinance. The asset quality in unsecured is going through its journey. We've seen the credit growth drop significantly from the highs of mid-teens to high teens. And of course, the rate cuts, which will also have its bearing on the margins initially, and then gradually we see how the deposit rates shape up. So clearly the earnings headwind still remains for the sector, and we are yet to see the bottoming of that to happen. We feel that the bottoming out of the earnings cut would most likely happen by June or September quarter. But what we are positive about is the regulators have started to support the sector. You talked about easing of liquidity. We have seen in the last couple of weeks, the regulators come out and ease certain measures such as rollback of risk weights on NBFCs or microfinance lending, etc., which is quite positive for the sector and will ease the regulatory risk premium. But clearly what the market is looking for at this point of time is the earnings cuts, when do they bottom out, what happens to the margins in the near term. But if you see last few months or so, banking sector on a relative basis has held up well, whilst the other sectors were seeing the beating. So we feel that as the confidence returns back on the fundamentals, I think the sector should start bottoming out, but the headwind still remains.
Okay, so maybe you're saying tactically people are looking at financials more favorably, but you're still concerned about some of these issues. I just want to focus on, Rahul, this asset quality piece that you touched upon. If you could expand on that. Where is it that you're still seeing stress? There was a lot of debate around this, that maybe the worst of the MFI stress will be over by, say, Q1. What are your projections telling you in terms of timelines? And also the RBI has actually withdrawn some of those macroprudential norms, right? The higher risk weights on loans that are going in for NBFCs or MFIs. So that's already been rolled back. So I don't know. Clearly the RBI felt that it was the right time. There was no need to be as tight anymore. But you still sound a bit concerned. So just elaborate on this.
Sure. Thanks, Urvi. So look, on the asset quality front, we started about 2 years back with our concerns on the unsecured lending. We've seen the last 6 to 12 months that reflects in the numbers for the financial entities. And then we saw how the macro slowed down. We all are witnessing what's happening to the GDP growth slowed down in between. The collection on the GST front were tepid. We also noted that the truck rentals or the freight movement also took a bit of a knock. That started reflecting in the higher delinquencies in some of the commercial retail assets, such as commercial vehicles or MSME loans, etc. So when you look at the bottoms up, I think we still have some way to go before the credit costs peak. We feel that it will likely to peak by September quarter. So still 2 more quarters to go for. But mind you that typically the second half in the financial year always tends to be stronger. But this year it has been a tad weaker, and we'll be getting into the first half, which generally is weaker. And there is a IMD projection out there which talks about the heat wave, etc. So I think that concerns the investors that when do we get the confidence on the earnings growth, and particularly if asset quality still remains a concern, then the re-rating takes time. But you rightly alluded to the point that the regulators have been doing to support the sector. I think that's been a big improvement in the last month or month and a half since the new governor has assumed. So we are seeing that the regulatory risk premium, which had gone up in the sector in the last 2-3 years due to tightening measures, should start to ease off, and these are some of the initial measures that the RBI has taken to support the sector. It will take time to show up in the real numbers, in the real economy numbers, or in the credit growth numbers. So we'll wait to see how that plays out.
Okay. Hi, Rahul. Good morning and good to see you in. Rahul, a couple of questions. I recall you calling out there's more pain in MFI, but do you think it's likely to peak out in the coming quarters? And also, I think you had preference for the housing finance companies, because, that's far more secured. Does that preference hold?
Thanks, Nigel. So look, I mean, microfinance, from where it is sitting, naturally, it should likely to improve in the subsequent quarters. But still, the profitability that used to be generated in this space will take time. Like I was earlier saying, second half is typically stronger, but this year it has been weaker, and we will be getting into a period which generally, has see a slower progress into the year. So we'll see. So it's going to take time. It's going to be more of a second half story into the next financial year than the immediate next few quarters. But yeah, I mean, on a relative basis, we've been very, very selective. We clearly like the stocks, where the asset quality is under control and the earnings predictability is very high. So whether it's housing or whether it's, commercial retail assets, wherever the ROAs and the asset quality is under control and valuations are not demanding, clearly are the names which, our investors are preferring at this point of time.
Interesting that you're saying that, Rahul, but I'm looking at the list of buy calls, and let's pull up the stocks as well for our viewers' reference. Chola Finance, there's SBI Card, there's Shriram Finance, then there is L&T Finance, AU SFB, Aavas, and the large banks include Kotak and HDFC Bank. So I just want to come exactly to that, Rahul, to understand the thought process behind the stock selection sort of criteria. And you said that asset quality needs to be stable. That's the number one thing that you're looking at. And then, of course, you're looking at overall valuations. So in the mix, I know you can't talk individual stocks, but I mean, SBI Card is the one I'm referring to. Let's not talk about the stock or levels. But in general, clearly, you're also pivoting towards some of the unsecured, lending setups, though you are cautious. So how does that tie in together? Is that a valuation thing?
Good question, Surbi. Thank you so much. So without getting into the specifics, I think financials is all about catching the cycles, right? So our view is very simple that at some stage, unsecured will likely to peak. And, we're already seeing from the bureau data, the credit card delinquencies have started to moderate. And particularly the book that has been written in the last year and a half is showing a much better trends. So as the balances builds up there, you will see an improving performance, coming out of this particular segment of unsecured. And we are calling out that, by June to September quarter, you will see the asset quality peaking for the whole sector. Now, basis this and what profitability each of these segments will generate and where, does the, valuations lie is the call that one needs to take. So like I said, we prefer the names where you've got some incremental comfort coming in on asset quality, profitability remaining, quite decent, and the valuations, have been derated over the last, few months or few quarters are the names that we are preferring. But at an overarching level for our investors, we, broadly categorize these into three buckets. First bucket belongs to the liquidity. As the liquidity gets better, some of these names will tend to benefit. The second is the interest rate sensitive. So the names where the impact of interest cut would be lower on the margins would also likely to benefit. And third is clearly, in terms of commercial retail assets versus the unsecured, where do you put your money? So I think unsecured is still going through the journey, will take at least a quarter or two more, and then you need to pick your bets. We clearly feel that credit card is early in the journey. You will see that first bottoming out because it is the first segment to go down when the cycles turn, and will be the first segment to come out when the cycles will start to improve.
All right, Rahul, we'll leave it there. Thank you very much for joining us, and it's a pleasure as always having you here on the program. Well, markets are seesawing a little bit. They were up, they were down, they're flat now, so 22,540. Mitesh is back with us. Mitesh, quick thoughts on what you're seeing and any trades at all?
So Prashant, I think, the idea remains that this is a market which on the hourly, 2-hourly charts is still doing that counter trend rally, and therefore declines should be bought into. And I believe that eventually in the next few days with some volatility, we will head towards 22,750, 800. With that kind of view, 22,350 is my support pivot. So get closer to that, about 22,400, 420, 430 zones. That's the buying area. And on the stock side also, we are trading with more of long bias. So I have a buy on EB Capital with a stop at 157.90. Look for target of around 168. And BHPL is the other one. That's a buy with a stop just below levels of 195 for targets of 212.
Okay, all right. Thanks for that, Mitesh. We'll take a very quick break on that note, come back in just a bit, and we'll be in conversation with Prashant Khemka, founder of White Oak Capital Management. Stay tuned. Welcome back. Let's get a market conversation going now. Some perspective at the end of what's been a week of relief for the Indian market. We have Prashant Khemka, founder of White Oak Capital Management, joining in. Prashant, always a pleasure listening into you. Thank you so much for being with us. And that's exactly what I was saying, right? Finally, a week of relief when India's outperformed as chaos and turmoil and confusion has gripped a lot of global markets. So that's really the question that, we don't want to get ahead of ourselves, but one can't help but start feeling a little excited that with the US market faltering, things a little confusing on tariffs over there, with these, will these elusive FPIs, will they finally start looking at India after the correction?
It is true that over the last few months, the massive selling that we've seen in India, in our assessment, is in great part to do with everyone around the world, big institutions, HNIs, or retail investors, they're all flooding money into the US and taking it out from elsewhere. And it's not about negative about India as much as it is negative about or more positive about US compared to everything else. Now, in case this little bit of volatility in the US, whatever it may be attributed to, if that leads to reassessment of that of investors' sentiment or investors' viewpoint that US is the only place to be, then yes, all other asset classes would see some relief. But it's very hard to say. It's markets are not. I correct myself as I correct everyone else. I correct myself. It's not just very hard to say. It's impossible to say how this would evolve going forward. But yes, as of now, market in US after some while has been more choppy than the unidirectional manner it was rising.
All right. Hi, Mr. Khemka. Good morning, and always good to hear your thoughts. Plenty of moving parts, right? Difficult to call which side the market's going to go. But fair to say that post this correction that we've seen in the Indian markets, the headline index is down close to 15%. Individual stocks are down 20, 30, 40%. Do you think bulk of the bad news is in the price? Or is the call for a sharper correction from here on? I want to understand how you're feeling about the Indian markets.
Sure, Nigel. So I generally tend to always believe it's a good time to invest and not try and time the market. And today, particularly after the drops that you mentioned in the headline, larger cap indices or broader indices, yes, I think the froth is out. So all the more reason to not worry about, though ironically, when markets go down like this 10, 15%, even those who think of themselves as long-term investors, they start worrying about it and try to play the impossible game of trying to pick the bottom or time the market. But I would say for any long-term investor, it is a very good time to stay invested, and if they aren't invested or have some money in cash, to deploy that. For short-term investors, I can only wish good luck as always, because that's what they need.
So, Prashant, the other issue is, like you're saying, it's impossible to predict which way the wind blows in the US with all this tariff business. But let's look at what's happening here at home. This whole sell-off was also triggered because of the concern around the Indian slowdown. and earnings trajectory, so on and so forth. So even if FPI money starts to come back, and when it does, we don't know, but the slowdown concerns here, do you think they are now fully priced in, and now we should look at a recovery in terms of both earnings and overall macro data?
So, Surbi, as you very well know, at any given point in time in the market or the economy and all these put together, the global politics and global economics, national politics, national economics, equity market and all the things associated, corporate earnings, and the various macro indicators. There are, as in Hindi you say, 17. So there are 17 things that are right, or 17 things that are right, and much more than 17, but let's say 17 things that are right and 17 things that are going wrong. Now, when markets are doing well, as they were till not long ago, people, everyone in media and investors and fund managers, they all tend to focus on and highlight those things that are going right. And when market, wobbles or pulls back a little, everyone prefers to, chooses to focus on the 17 things that may not be going right. So all this slowdown in the past, whatever many years you pick, 5, 10, 20 years, there have been numerous such slowdowns that have come along the way. Even if you take the last, 11 years or so of Modi regime, there have been a number of times that slowdowns have occurred. But then, that's part and parcel. You won't have a 6% GDP growth like a smooth line. Just like we haven't achieved that over the last 30 years, where our average has been 6%, we've not achieved it in a smooth line. And the same way, we haven't achieved whatever 12% annualized return that the market has given over the last 30 plus years, since early 90s, since liberalization. We haven't achieved in a straight line, and we're not going to achieve that in a straight line. These ups and downs are going to come. 3 to 4 months, 3 to 6 months ago, everyone was complaining, market's too high, I'll wait for a correction. Now, when there is a correction, everyone was worried, oh, this thing is going bad, that thing is going bad. Nothing is much different from what it was 6 months ago. It's just that people are now choosing to talk more about those things, those 17 things that aren't so rosy. And now that you have a correction, you want to wait for everything to be rosy. Everything's never going to be rosy.
Okay, all right, Mr. Khemka, good to hear your thoughts. A short point, I think you're sounding bullish on the markets. You believe, as always, for a longer-term investor, it's a good time to buy post this recent correction, and you're not too worried about the near-term, uncertain patch that we're likely to see. Thanks a lot for joining in, but we look forward to having a longer conversation with you in the coming weeks as well.
Likewise, thank you.
Well, as we had that conversation with Mr. Khemka, take a look at the markets. We've seen a good recovery, courtesy Reliance Industries. That's the one that's fighting for the bulls in today's trading session. Time to slip into a short break. On the other side, we'll have a special segment, Indianomics. Lata is going to be joining, and she'll be celebrating International Women's Day by discussing finance and the economy with top 4 women bankers from Standard Chartered Bank. Stay tuned for that conversation.